All right, picture this. You get an envelope. Maybe it looks official, maybe from the IRS, and inside there's this tax form. It doesn't look familiar. Your stomach does a little flip, right?
Oh, yeah.
Especially if it's Form 1040-NR, the U.S. non-resident alien income tax return. The first thought isn't usually, oh, great. It's more like, okay, how am I going to mess this up? Am I missing some huge tax break here?
That feeling is incredibly common.
Yeah.
Trying to navigate a tax system that isn't your home turf.
Mm-hmm.
It can feel like, doing a jigsaw puzzle with half the pieces upside down.
Totally.
And that fear of missing a rule or overlooking some way to save money,
Mm.
that can really stop you in your tracks.
Exactly. And that's why we're here today. Our mission for this deep dive is to take the mystery out of Form 1040-NR.
Mm-hmm.
We're going to break down the key parts, shine a light on this kind of unique rules that only apply to non-resident aliens, and crucially, point out those strategies, those little details in the instructions that can actually help you lower your tax bill.
Think of us as your guides.
Yeah. Helping you tackle this thing with a bit more clarity, maybe some confidence, and hopefully a few aha moments along the way.
It really is about giving you that practical knowledge. A lot of the big tax savings for non-residents, they're not about complicated schemes. It's more about understanding these specific differences.
Yeah.
Knowing which little box to check, which form applies to your situation, will show you where those gems are hidden.
Okay, so let's start at the very beginning, the crucial first step. Are you actually a non-resident alien for tax purposes? Because honestly, before you even squint at Form 1040-NR, you've got to nail down your tax residency status.
Right.
It's not always straightforward, and it completely changes which forms you use, what deductions you get, everything.
You've hit the nail on the head. That's the absolute foundation.
Yeah.
The IRS has really specific tests for figuring out if you're a U.S. resident for tax purposes. And it's important to remember, this isn't necessarily the same thing as your immigration status.
Good point.
The main test they use, it's called the substantial presence test.
The substantial presence test. Okay, sounds a bit official. What's the basic idea?
It boils down to counting days. Basically, how many days have you physically been in the U.S. over the last 3 years? To meet the test, you need to be here for at least 31 days in the current calendar year, and you need to rack up 183 testing days over the current year, plus the 2 before it.
Okay, testing days. How do they calculate those? It's not just 1 day equals 1 day, is it? I remember something about fractions.
That's right. Yeah, it's a weighted system.
Yeah.
So for the current year, every single day you're here counts as 1 full day. Simple enough.
Got it.
But for the year before the current one, each day only counts as 1/3 of a day. And for the year before that 2 years back, each day counts as just 1/6 of a day.
Ah, okay.
So if we're figuring this out for, say, 2024, you count all your 2024 days, plus 1/3 of your 2023 days, plus 1/6 of your 2022 days, add them up. If the total is 183 or more, and you hit that 31-day minimum for 2024, then bam, you generally pass the substantial presence test. You're usually considered a resident alien for tax.
And if you want to double-check that math,
The detailed worksheet is right there in IRS Publication 519. It walks you through it step by step.
okay, that weighted system is key. So generally, anytime you're physically in the U.S. during a day, that day counts. But are there exceptions? Like days that just don't count towards this test? This feels like it could be a big deal for some people.
Absolutely. This is where you might avoid being classed as a resident, even if you spend a fair bit of time here. For instance, days you commute regularly to work in the U.S. from your home in Canada or Mexico, those don't count.
Okay, commuters are out. What else?
If you're just passing through, like in transit between 2 foreign places, and you're in the U.S. for less than 24 hours, those days don't count either. Also, if you're a regular crew member on a foreign ship doing international transport, those days are usually exempt.
Usually. What's the catch?
Well, unless you're also doing other business activities in the U.S. on that same day, then it might count.
Gotcha. Any other big exceptions?
Yeah, a couple more. Days you fully intended to leave the U.S. but couldn't because of a medical condition that popped up after you got here, those are excluded. It's pretty specific unforeseen medical issues.
Okay.
And days you spent here under a NATO visa as part of a NATO force or civilian component, generally exempt. But, and this is a critical distinction, this NATO exception doesn't apply to the immediate family members on the same visa. Their days do count.
Wow. Okay, so family members of NATO personnel still count their days. That's specific.
Very. And then there are exempt individuals like certain students, teachers, trainees, folks connected to foreign governments. The rules for who qualifies as exempt are detailed. You need to check other IRS publications like Pub 519 again for the full definitions there.
Okay, that's a lot of ways not to count days, which is
Yeah.
good to know. But what if you run the numbers, you do the math with the fractions, and boom, you meet the substantial presence test? The calculation says you're a resident, but in your gut, you feel like, no, my life, my home, it's still back in my home country. Is there any way to, override the math?
Yes. And this is where things get really interesting for potential tax savings. Even if the day counting formula says you're a resident, you might still be treated as a non-resident alien if you can claim something called the closer connection exception.
The closer connection. Okay, that sounds useful. How does that work? What's the gist?
The basic idea is simple. Even if the IRS's day counting says resident, your actual life circumstances might scream non-resident. To qualify for this exception, you need to meet 3 conditions.
Okay, what are they?
First, you had to be present in the U.S. for fewer than 183 days during the current tax year. So even if you met the 3-year weighted test, you didn't spend half the current year here.
Right, less than 183 days this year.
Second, you need to maintain what the IRS calls a tax home in a foreign country throughout the year.
And third?
Third, you have to establish that during the year you had a closer connection to the foreign country where your tax home is compared to your connections to the U.S.
How do you prove that? What kind of connections are they looking for?
It's about the center of your life, really.
Yeah.
Where does your family live? Where do you keep your important personal belongings like cars, furniture, jewelry? Where are your main banking relationships? Social, cultural, religious ties? Where do you vote? Things like that. You paint a picture showing your life is fundamentally based in that other country.
So it's proving your roots are elsewhere, even if you spent some time here. That's a potentially huge tax saver because it completely changes your filing status. But how do you actually tell the IRS, hey, I'm claiming this closer connection thing?
You can't just, feel it. You have to formally claim it. You must file Form 8840, the closer connection exception statement, with the IRS by the due date for filing your tax return.
Form 8840. Got it.
And heads up, if you're married, both you and your spouse want to claim this, you each have to file your own separate Form 8840.
One form per person. Okay. Is this automatic if you meet the criteria?
No, absolutely not. Filing Form 8840 is mandatory. If you meet the conditions but don't file the form on time, you generally lose the chance to claim the exception. You'll likely be treated as a resident alien based on the substantial presence test.
So, filing that form is non-negotiable. What could mess this up? Are there any big red flags that would just automatically disqualify you from claiming a closer connection, even if you feel it's true?
Yes, there are some definite deal breakers. The big one is taking steps towards becoming a lawful permanent resident of the U.S.
Like applying for a green card.
Exactly. If you have a pending application for adjustment of status, or if you've applied for, or even just taken initial steps to apply for lawful permanent residence, a green card, you are not eligible for the closer connection exception for that year.
Why not?
Because the IRS sees those actions as showing a clear intent to reside in the U.S. permanently. That intent overrides any claim that your connections are closer to another country. Basically, your actions speak louder than your Form 8840 in that case.
Makes total sense. Actions speak louder than words. Okay, let's flip the script. What if someone doesn't meet the substantial presence test? They are clearly a non-resident based on the days, but maybe for strategic reasons, they want to be treated and taxed as a U.S. resident for the whole year. Can they choose to do that?
Yes, they can, actually, but only under very specific circumstances. It's a strategic choice, sometimes made for simplifying family taxes or accessing certain benefits only available to residents.
What are the conditions for making that choice?
Okay, to make this election, choosing to be treated as a resident for the entire year, you generally need to meet these points. 1, you have to be married at the end of the tax year. 2, your spouse must have been a U.S. citizen or a resident alien on the very last day of that tax year. And 3, you and your spouse must file a joint tax return for that year using the standard Form 1040 or Form 1040-SR.
So it's really for married couples where one spouse is already a U.S. person, tax-wise, and the other is a non-resident. They can basically say, let's just file together as residents. That sounds like it could make life easier for some families, maybe getting access to joint filing rates or certain credits. Are there any major downsides or things to watch out for?
Oh, definitely. There's a very significant caveat. This election, it's generally a one-time deal. Once you make it, you usually can't make it again in the future if it gets terminated for some reason.
Okay, one shot.
And perhaps even more importantly, making this choice might mean you give up benefits you would otherwise get under a U.S. income tax treaty with your home country.
Ah, treaty benefits. That's huge.
It can be.
Yeah.
So before you jump into this election, you absolutely must check the specific tax treaty between the U.S. and your country. See what you might be losing. This is definitely not a decision to make lightly. Consulting a tax professional who understands both U.S. tax law and treaties is probably a very good idea here.
Good advice. Not a casual choice at all. Okay, let's talk about one more status situation before we dive into the form itself. Dual status taxpayers. What does that mean?
A dual status taxpayer is someone who is both a non-resident alien and a resident alien in the same tax year.
How does that usually happen?
Most often, it happens in the year. Someone either arrives in the U.S. and becomes a resident partway through the year, or the year they leave the U.S. and give up residency partway through. So you have a period of non-residency and a period of residency within that single January to December timeframe.
Okay, so your tax year is split. Does that mean different rules apply to your income depending on when you earned it during that year?
Exactly. It's like drawing a line in the sand on the date your residency status changed. For the part of the year you were a U.S. resident, all your worldwide income earned during that period is subject to U.S. tax, just like any other U.S. resident. You use the regular tax rates, and you can generally take the standard deduction or itemized deductions on Schedule A of Form 1040 for that period.
Okay, resident period taxed like a resident. What about the part of the year you were a non-resident?
For the period you were a non-resident alien, the rules we've been discussing kick in. Only your income that's effectively connected with a U.S. trade or business, ECI, is taxed at those same regular U.S. rates, and you can generally take deductions against that ECI.
And what about income that's not effectively connected during that non-resident stretch? Like U.S. dividends or interest earned while you were still non-resident?
That's the key difference. U.S. source income earned during your non-resident period that is not effectively connected, NECI, is usually hit with that flat 30% tax rate.
Yeah.
Or potentially a lower rate if a tax treaty applies.
And crucially,
no deductions are allowed against that NECI.
Yeah.
Zero. Zilch. Even if you had expenses related to earning it. So this really underscores why correctly splitting your income and deductions between your resident and non-resident periods is absolutely vital for dual status folks. And it's also important to remember, Schedule A for Form 1040 for the resident part is very different from Schedule A for Form 1040-NR, which you might use for deductions against ECI in the non-resident part. They allow different things.
that difference in deductions, especially for the NECI, can make a massive difference to your final tax bill. Okay, so let's assume you've navigated the residency maze, you know your status, now you're staring at the Form 1040-NR itself. Let's walk through the blueprint, starting with that basic identifying info on pages 1 and 2.
Right. The top part is pretty straightforward. Your name, current mailing address, country of citizenship. If it's for an estate or trust, you use the name from the entity's paperwork, like the Form SS4 application.
And the ID number, SSN or ITIM.
Yep. You need either your Social Security number, SSN, if you're eligible for one, or an individual taxpayer identification number, ITIN, if you're not. One of the other is required.
Okay. Now, filing status. This is a big departure from the regular Form 1040, right? What are the options for non-resident aliens? And maybe more importantly, what's not allowed?
This is a super critical section and a frequent point of confusion. If you're filing Form 1040-NR, your choices are generally limited to single or married filing separately.
Even if you're married and living together?
Yes.
Right.
Even if you're happily married and living with your spouse, if you're filing 1040-NR, the default is almost always married filing separately. The only way around that is if you meet one of those very specific exceptions, like the election to be treated as a resident we talked about earlier, which means you'd be filing Form 1040 jointly, not 1040-NR anyway.
So what statuses are completely off the table for 1040-NR?
Explicitly not allowed for Form 1040-NR filers are married filing jointly and head of household. You just can't use those statuses on this form.
That's a big one. Joint filing often comes with benefits for U.S. residents. What about dependents? The form mentions them. Can non-resident aliens claim kids or other dependents for tax breaks?
Another area where expectations might not match reality. While the form does have spots for dependents, some of the biggest tax benefits tied to dependents in the U.S. system are largely unavailable to most people filing Form 1040-NR.
Like which ones?
Specifically, the child tax credit, the credit for other dependents, and the additional child tax credit. For most non-resident aliens, you simply can't claim these.
Are there any exceptions?
Very limited ones. Residents of Canada and Mexico can often claim these credits similar to U.S. citizens. There are also some specific, often limited provisions for residents of South Korea and certain students who are business apprentices from India. But for the vast majority of non-resident aliens from other countries, no dice on those major dependent credits.
Good to know. Don't just assume you get those credits. Okay, moving down the form to other information, Schedule OI, items F and G. They ask for your visa type or immigration status and all your entry and exit dates for the year. Why does the IRS need all that detail?
It helps them verify your residency status determination and understand the context of your presence in the U.S. for tax purposes. You'll need to list your visa type like F1 student, H1B worker, J1 exchange visitor, B1, B2 visitor, etc.
What if you didn't use a visa, like under the visa waiver program?
Then you'd list your U.S. immigration status on the last day of the tax year. So VWP for visa waiver program, for example.
And those dates. Entering and leaving, that could be a really long list for frequent travelers.
It definitely can be. You're supposed to list every single date you entered and left the United States during the tax year. Business trips, vacations, quick visits home, all of them. If you run out of space on the form, you just attach a statement with the rest.
Is there any break for people who cross the border constantly?
Yes, thankfully. There's an exception for regular commuters from Canada or Mexico. If you live in Canada or Mexico and commute to work in the U.S. on more than 75% of your workdays during the year, returning home within 24 hours, you're considered a regular commuter. You don't need to list all those daily entry and exit dates.
That's practical. Okay, and total days present. Is that just counting every day you were physically here?
Generally, yes. Any part of a day spent in the U.S. counts as a day of presence. However, remember those exceptions we talked about way back for the substantial presence test, like days commuting from Canada to Mexico, transit days, certain medical issue days? Those same types of days generally don't count toward this total days present number either.
So the days that don't count for the residency test also don't count here. Consistent.
Right. It's about counting the days that are relevant for the IRS's residency determination.
Now, here's something interesting tucked away in Schedule OI, Item K, Compensation Allocation Method. This sounds potentially important, especially for higher earners. What's this about?
This is a nuanced point, but yes, it can be very significant. You need to pay attention to this if your total compensation that's including both U.S. and non-U.S. source pay is $250,000 or more for the year.
Okay, high earners. What's the trigger?
If your total top is $250K plus laid, and you use an alternative method to figure out how much of that compensation is U.S. source versus foreign source, meaning you're not just using the standard time basis allocation, days worked in U.S. versus total days worked, then you must check a box in Item K and attach a detailed statement explaining your method.
Why would someone use an alternative method instead of just counting workdays? What's the potential benefit?
Because, as the IRS instructions put it, an alternative method might more properly determine the source of compensation. That phrasing hints at a major tax-saving opportunity.
How so?
Well, imagine your pay includes a large bonus specifically tied to a project completed entirely outside the U.S., or maybe deferred compensation linked to work done years ago while you were non-U.S. based. A simple time-based allocation for the current year might incorrectly label too much of that income as U.S. source.
So an alternative method could let you argue that less of your income should be taxed by the U.S.
Exactly. It could potentially reduce your U.S. source income and therefore your U.S. tax liability. But, and this is but you need a very strong justification. Your attached statement needs to be thorough, identify the specific compensation, explain the alternative method, show the calculation, and compare the results, the U.S. versus non-U.S. source amounts, using both your method and the standard method.
Sounds like you need meticulous records for that.
Absolutely meticulous. And it's probably wise to get professional advice if you're considering this, as the IRS will scrutinize these claims, but it's a potentially powerful tool for the right situation.
Definitely something for high earners with complex compensation to look into. Okay, let's move into the real meat of any tax form. Income, lines 8 through 11, 1K, Schedule NEC, etc. How does the IRS categorize earnings for non-resident aliens? You mentioned a fundamental divide earlier.
Yes, this is the absolute bedrock of non-resident alien taxation. Everything hinges on distinguishing between two types of income: effectively connected income, ECI, and U.S. income not effectively connected, an NECI. Getting this right is job number one.
Okay, ECI versus NECI. Give us the simple breakdown.
ECI, effectively connected income. Think of this as income earned from actively engaging in a trade or business within the United States. Performing personal services in the U.S. is generally a U.S. trade or business, so wages are usually ECI.
And the good news about ECI is?
The good news is that ECI is taxed at the same graduated tax rates that apply to U.S. citizens and residents. And, critically, you can generally claim deductions related to that ECI. This is huge for reducing your taxable income.
Okay, so ECI is typically regular rates, deductions allowed. Now, NECI, income not effectively connected.
NECI is typically passive-type income from U.S. sources that isn't tied to a U.S. trade or business. Common examples include certain types of interest, dividends, royalties, rent, unless you make that election we'll talk about, and even U.S. Social Security benefits if they're not related to a business you run here.
And how is NECI taxed?
This is where it usually hurts more. NECI is typically subject to a flat tax rate of 30%. Flat. No graduated brackets.
30%. Ouch, is there any relief from that?
Yes, potentially. If there's an income tax treaty between the U.S. and your country of residence, that treaty might specify a lower rate for certain types of NECI, maybe 15% or 10% or even 0% for specific items like certain interest or royalties. Checking the treaty is vital here.
And the deduction situation for NECI?
This is the other crucial part.
Yeah.
Generally, no deductions are allowed against NECI. That 30% or lower treaty rate applies to the gross amount of the income. You can't subtract expenses you might have incurred to generate it.
So misclassifying ECI as NACI means you lose deductions. Misclassifying ACI as ECI could mean paying tax at potentially higher graduated rates, but maybe getting deductions you weren't entitled to. Getting it right is key.
Absolutely critical. It impacts the rate, the deductions, everything. It's not just about compliance, it's about making sure you're paying the correct and hopefully minimum amount of tax legally required.
Okay, let's look at some specific income types and how they fit into this ECI framework on the form. Wages and salaries, line 8, that's usually ECI, right?
Yeah. Yes. Generally, wages, salaries, tips, commissions earned for working in the U.S. are considered ECI. This line captures your typical W-2 income, but also some less common things like wages paid to household employees, tip income you need to report, certain Medicaid waiver payments treated as difficulty of care payments, and even employer-provided adoption benefits, which might link to other forms like Form 8839.
Got it. Now, line 1K and Schedule OI, item L, you flagged this earlier as a major tax saving spot, treaty-exempt income.
Yes, this is potentially one of the most significant benefits available to non-resident aliens. Treaty-exempt income is income that, thanks to a specific provision in an income tax treaty between your country and the U.S., is completely exempt from U.S. tax.
Like what kind of income might be exempt?
It varies hugely by treaty, but common examples include income earned by students, trainees, teachers, or researchers who are temporarily present in the U.S., or certain types of pension income. You must check your specific treaty.
How do you report this correctly to make sure you get the exemption? Messing this up seems like it could be costly.
Precision is key. You report the total amount of your treaty-exempt income on line 1K of Form 1040-NR. You also must provide details in Item L of Schedule OII. You list the country, the specific treaty article provided the exemption, the number of months you claimed it during the year, and the amount.
And the crucial instruction is,
do not include this treaty-exempt income on any other income line on the form, like line 8 for wages. It only goes on line 1K and Schedule OI. You also generally need to attach any Form 1042-S foreign person's U.S. source income subject to withholding that shows this income and claims treaty benefits. And sometimes you might also need to attach Form 8833, Treaty-Based Return Position Disclosure Statement.
okay, so report it specifically, don't double count it elsewhere, and attach the proof. Where can people find these treaties to see if they qualify?
The IRS website is the place to go, irs.gov tax treaties. They have a comprehensive list and the full text of most U.S. income tax treaties. It's definitely worth taking the time to read the one for your country.
Good resource. Okay, let's talk interest income. Lines 2A and 2B is all U.S. interest taxed.
Not necessarily, especially for non-resident aliens. Let's break it down. Line 2A is for tax-exempt interest. For a 1040-NR filer, you'd only report tax-exempt interest here if it was somehow effectively connected with the U.S. trade or business, which is rare for interest.
What about typical bank interest?
That's usually the big exclusion. Interest earned on deposits with U.S. banks, savings and loans, credit unions, or certain amounts held by insurance companies is generally not considered ECI and is often tax-exempt for non-resident aliens under the tax code itself, Section 871I, or potentially a treaty. So most typical U.S. bank interest wouldn't even be reported on the 1040-NR.
Okay. What about taxable interest on line 2B?
For line 2B, you only include taxable interest that is effectively connected with the U.S. trade or business.
Mm.
If you have U.S. source taxable interest that is not effectively connected, where does it go?
Schedule NEC.
Exactly. It goes on Schedule NEC, tax on income not effectively connected with the U.S. trade or business, where it's subject to that flat 30% rate or a lower treaty rate unless it happens to be tax exempt under a treaty and had no tax withheld.
So again, that EC and SCI distinction is crucial even for interest. What about business income or loss, usually from a sole proprietorship reported on Schedule C, that goes on Schedule 1, Line 3?
Right. And for Form 1040-NR, any income or loss reported here must be ECI. It has to be from a U.S. trade or business.
Are there special rules for, say, traders or dealers in stocks or securities?
Yes, there's an important nuance. If you're a dealer in stocks, securities, or commodities, but you conduct your trading in the U.S. solely through an independent agent, like a resident broker or custodian, the income from those activities might not be considered ECI.
So trading through a U.S. broker might mean the income is NECI?
It could, which means it might fall under that 30% flat tax or treaty rate on Schedule NEC with no deductions for trading expenses against it. That's a huge difference compared to being ECI where you'd pay regular rates but get deductions. It depends on the specifics of your activity and whether you have a U.S. office or agent with discretionary authority. Definitely complex.
A critical point for international investors and traders. Okay, what about income from rentals, royalties, partnerships, estates, trusts? That's typically on Schedule 1, Line 5, coming from Schedule E.
Correct. And just a reminder for listeners, despite what the standard Schedule 1 instructions might mention about S corporations, remember, Form 1040-NR filers cannot be shareholders in S corporations, so ignore that part.
Right. Now, rental income from U.S. property. How is that normally treated for a non-resident alien?
General U.S. rental income for a non-resident is considered NECI, passive income,
Which means?
which means it's typically subject to that flat 30% tax on the gross rent received with no deductions allowed for expenses like mortgage interest, property taxes, repairs, depreciation. Ouch.
That sounds potentially brutal for a landlord. Is there a way around that?
Yes. Another huge potential tax-saving election here. You can elect to treat your income from U.S. real property as if it were effectively connected income, ECI.
Ah, the real property election. Why would you choose to treat it as ECI if it means paying regular graduated rates?
Because making the election allows you to deduct all the ordinary and necessary expenses associated with that rental property. You can deduct mortgage interest, property taxes, management fees, maintenance, insurance, and importantly, depreciation.
So you trade the flat 30% on gross income for potentially much lower graduated rates on the net income after expenses.
Exactly. For most real estate investors with typical expenses, this election results in significantly less tax. It turns a potential loss leader into something where you're only taxed on the actual profit.
How do you make this election? Does it require a special form?
No special form, but you need to attach a statement to your Form 1040-NR for the year you make the election. The statement needs to clearly state you're making the election, provide a complete list of all your U.S. real property holdings, indicate the extent of your ownership in each, give their locations, describe any major improvements, and state the dates acquired.
This sounds like a must-do for almost any non-resident alien investing in U.S. rental property.
It often is, yes. It's a very powerful choice.
Okay, one last income type to cover specifically. U.S. Social Security benefits. How are those taxed for non-residents? Schedule NEC, Line 8.
Yes. For most non-resident aliens receiving U.S. Social Security benefits or equivalent Tier 1 railroad retirement benefits, 85% of the total benefits received are considered taxable U.S. source income.
And is it ECI or NECI?
It's generally treated as NECI, not effectively connected with a U.S. trade or business.
So that means?
It means that 85% chunk is generally subject to the flat 30% tax rate reported on Schedule NEC. Again, a tax treaty between the U.S. and your country might provide for a lower rate or even exempt these benefits entirely, so checking the treaty is crucial. But under standard U.S. law, it's 30% on 85% of the benefits with no deductions allowed.
Okay, so recapping income. ECI versus NECI is king. Understand that distinction. Leverage treaties wherever possible, especially for NECI rates and exemptions. And look for those specific elections, like the real property income election, that can shift income into a more favorable category, allowing deductions.
That's the perfect summary. That understanding is the foundation for everything else on the return. Now, let's shift gears to the next major area for potential tax savings, although often with more limitations for non-residents. Adjustments to income and tax credits.
Mm.
This is where you find your tax-saving toolkit.
Right. Starting with adjustments to income on Schedule 1. These are sometimes called above-the-line deductions because they reduce your gross income to get to your adjusted gross income, AGI. Lowering your AGI is generally a good thing. What adjustments are typically available for 1040 NR filers?
Many of the common ones you see on a regular 1040 are available, but usually with the condition that they relate to income that is effectively connected.
Such as
You can generally deduct student loan interest you paid. If you're subject to U.S. self-employment tax because of a totalization agreement between the U.S. and your home country's social security system, you can deduct 1/2 of those self-employment taxes. You'd likely need to file Schedule SE. Educator expenses, if you're an eligible educator and the expenses relate to your ECI job, are deductible up to the limit. The Health Savings Account, HSA deduction, is also generally available if you qualify.
What about the deduction for self-employed health insurance premiums? That one seems complicated even for residents. Any special hoops for 1040 NR filers? Schedule 1, line 17.
It definitely has some specific wrinkles for non-residents. First off, the rules that apply to S-corporation shareholders taking this deduction don't apply because, as we said, non-residents can't be S-corp shareholders.
Okay.
Also, you can't use certain calculations that might involve itemized medical expenses on the regular Schedule A, Form 1040, because Schedule A for Form 1040 NR doesn't even have a line for medical expenses.
Good point.
The rules related to coordinating with the foreign earned income exclusion, Form 2555, also don't apply, because you can't claim that on 1040 NR. And critically, if you're calculating the deduction based on premiums potentially eligible for the premium tax credit related to marketplace insurance, that credit component is generally only available if your dependent qualifies and you are a U.S. national or a resident of Canada, Mexico, or South Korea, or a specific type of student apprentice from India covered by the treaty.
So very limited interaction with the premium tax credit for most 1040 NR filers.
Extremely limited. And one more change for 2024, if you could take the self-employed health insurance deduction, but the standard worksheet in the Form 1040 instructions doesn't work for your situation, which might happen due to these 1040 NR limitations, you now have to use a separate form, Form 7206, to figure it out instead of relying on Publication 535.
Form 7206. Got it. That's a lot of specifics for just one deduction. How about IRA deductions, line 20? Can non-residents contribute to an IRA and get a deduction?
Yes, potentially, but again, with conditions tied to ECI. First, you have to follow the filing status rules specific to Form 1040 NR when determining your deduction limits. You can't base your contribution limit on your spouse's earned income or any alimony received. The rules interacting with Form 25555 don't apply. And the absolute key, you must have taxable compensation that is effectively connected with a U.S. trade or business to be eligible to make a deductible IRA contribution as a non-resident alien. No ECI compensation, no IRA deduction.
Makes sense. It has to link back to U.S. taxable earnings. Now, you mentioned something earlier, a unique one-time charitable thing from an IRA.
Ah, yes, the Qualified Charitable Distribution, or QCD, one-time election. This is quite interesting. For 2024, you can elect to make a one-time distribution of up to $53,000 directly from your IRA to certain charities through a split interest entity, like a charitable remainder annuity trust or charitable remainder unit trust.
Why would you do that instead of just donating normally?
Because this specific type of distribution can count towards your required minimum distribution, RMD, if you're old enough. But more importantly here, it can potentially be excluded from your gross income, effectively giving you a deduction above the line by reducing your taxable IRA distribution. It's a very specific planning tool detailed in Publication 590B, but could be powerful for charitably inclined retirees with IRAs and ECI.
$53,000 potential exclusion.
Yeah, that's significant. Okay, what common adjustments are definitely not available for 1040 NR filers, things residents might take for granted?
A couple of the big ones. The deduction for alimony paid, line 19, is generally not allowed on Form 1040 NRR. And as we've mentioned a few times, the foreign earned income exclusion, the foreign housing exclusion, and the foreign housing deduction, all claimed using Form 2555, are absolutely not available to someone filing Form 1040 NR. You have to be a U.S. citizen or resident alien meeting specific tests to claim those. Okay, good to know what's off the table. Let's dig deeper now into itemized deductions. Schedule A for Form 1040 NR. This is where you choose, instead of taking the standard deduction, if itemizing gives you a bigger benefit, what can non-residents typically itemize? Let's start with state and local taxes. Line 1A, 1B.
You can deduct state and local income taxes that you paid or had withheld during the year, but again, the key is they must be taxes imposed on income that is effectively connected with your U.S. trade or business.
So state income tax withheld from your U.S. paycheck, for example.
Exactly. But not state income taxes paid on, say, NECI investment income generally. And there's a major limitation here, same as for residents. The total deduction for all state and local taxes, including income tax and potentially property taxes if connected to ECI, is capped.
What's the cap?
It's limited to $10,000 per household per year. Or, if you're using the married filing separately status, which most 1040 NR filers must, the cap is $5,000.
$10K total, $5 CALers if married filing separately. That's the SALT cap. What about that interaction with charitable donations and state tax credits? You mentioned a safe harbor.
Right. This is a bit complex. Sometimes states offer tax credits for donations to certain state-approved charities. Normally, if you get a state tax credit back for a donation, you have to reduce your federal charitable deduction by the amount of the credit.
Okay.
However, the IRS created a safe harbor. If your federal charitable deduction is reduced because of a state income tax credit you received, you might be able to treat the amount of that reduction as a payment of state and local income tax instead, up to the $10,000, $5,000 SALT cap. It potentially lets you still get a federal deduction for that amount, just as a tax payment instead of a charitable gift.
Interesting way to potentially salvage the deduction. Okay, now for what can be a really big itemized deduction, gifts to U.S. charities. Lines 2 through 4, what kind of organizations qualify?
The key word here is U.S. organizations. You can generally deduct contributions made to organizations that are religious, charitable, educational, scientific, or literary in purpose, or those working to prevent cruelty to children or animals. This includes churches, synagogues, mosques, nonprofit schools and hospitals, organizations like the Red Cross or Goodwill, and even federal, state, or local governments if the gift is solely for public purposes.
How do you know for sure if an organization qualifies?
The best way is to use the IRS's online search tool called the Tax Exempt Organization Search, or TEOS. You can find it easily on irs.gov TEOS. That will confirm if the organization is registered as a 501c3 charity.
Good tip. What kind of donations can you deduct? Cash, property?
Yes, cash, checks, electronic fund transfers, payroll deductions. Also, the fair market value of donated property, like clothing or goods to Goodwill, though there are rules about valuation and condition. And don't forget out-of-pocket expenses you incur while doing volunteer work for a qualified charity.
Like driving your car.
Exactly. You can deduct the actual cost of gas and oil, or take the standard mileage rate, which is 14 cents per mile for charitable driving in 2024. Plus, you can deduct parking fees and tolls related to that volunteer work.
What if you get something back for your donation, like a dinner or tickets?
If you receive a benefit in return for your contribution, you can generally only deduct the amount of your contribution that exceeds the value of the benefit you received. So if you pay $100 for a charity gala ticket and the dinner and entertainment are valued at $60, you can only deduct $40. The charity should usually tell you the value of the benefit.
Okay. What about larger donations? Say $250 or more in a single donation. Are there special proof requirements?
Absolutely critical point here. For any single contribution of $250 or more, cash or property, you must obtain a contemporaneous written acknowledgement from the charity before you file your return. You don't attach it to your return, but you must have it in your records.
What does contemporaneous written acknowledgement mean? What needs to be on it?
It means you need a written record for the charity, like a letter or email. That includes the amount of cash donated, or a description, but not value, of any property donated. It also must state whether the organization provided any goods or services in return for the contribution. If they did provide something, it needs a description and a good faith estimate of the value of those goods or services. If they provided only intangible religious benefits, it needs to state that.
So no acknowledgement, no deduction for $250 plus gifts. Very important. Are there limits on how much you can deduct overall for charity?
Yes, your charitable contribution deduction isn't unlimited. It's generally limited based on a percentage of your adjusted gross income, AGI. The limits vary depending on the type of organization and the type of property donated. For cash gifts to public charities, the limit is typically 60% of your AGI, but for non-resident aliens, the calculation might be based only on U.S. source AGI, and some specific limits like 30% for cash or 20% for capital gain property might apply depending on the situation. It's detailed in PEP 526.
And if you donate more than the limit allows in 1 year?
If your donations exceed the AGI limits for the year, you can generally carry over the excess amount and deduct it in the following tax year for up to 5 years total. So the deduction isn't necessarily lost, just deferred.
Okay, now for the flip side, which is just as important for getting it right, What can you not deduct as a charitable contribution? Let's list the common pitfalls.
This is crucial for avoiding mistakes. You cannot deduct contributions where you get a state or local tax credit back, unless that safe harbor for treating it as a tax payment applies. Payments made to get the right to buy tickets for college athletic events. Travel expenses for volunteer work if there's a significant element of personal pleasure, recreation, or vacation involved.
Okay.
Contributions made directly to political candidates or parties. Dues or fees paid to country clubs, lodges, fraternal orders, or similar groups, unless the payment is specifically earmarked and used exclusively for charitable purposes by that group. The cost of raffle, bingo, or lottery tickets, that's considered gambling, not donating, though gambling losses up to winnings might be deductible elsewhere on Schedule A, line 7. The value of your own time or services you volunteer. You can deduct out-of-pocket expenses, but not the value of your labor. Gifts made directly to individuals, no matter how needy they are. It has to be to a qualified organization. Gifts to groups run for profit. And a really big one for non-resident aliens. Gifts made directly to foreign organizations. Generally, not deductible.
Are there any exceptions for foreign charities?
Very limited ones. You might be able to deduct contributions to a U.S. organization that then transmits funds to a foreign charity, provided the U.S. org has control. And specific tax treaties with Canada, Mexico, and Israel allow direct deductions to charities in those countries under certain conditions. But the general rule is, donate to U.S. charities to get the U.S. tax deduction. Check publication 526 for all the details.
The foreign organization rule is huge. Okay, what about record keeping for smaller cash donations under $250? Do you still need proof?
Yes. For any cash, check, or other monetary contribution, regardless of the amount, you need a record. This can be a bank record, like a canceled check, bank statement, or credit card statement clearly showing the charity's name, date, and amount, or a written communication from the charity, like a receipt, showing the same information. You absolutely need one or the other to back up your deduction. No proof, no deduction, even for small amounts.
Keep those records. Okay, so cash check donations go on line 2, non-cash donations on line 3, likely needing Form 8283 if over $500, and carryovers on line 4. What else can be itemized on Schedule A, 1040 at NR? Line 6 is casualty and theft losses.
Right. This is for losses of property due to events like fire, storm, shipwreck, theft, accidents, etc. that are not covered by insurance. You generally need to use Form 4684, casualties and thefts, to figure the deductible amount. There are thresholds based on your AGI that limit the deduction. It's all detailed in publication 547.
Is there anything special about disaster losses?
Yes. If you have a net qualified disaster loss, which is calculated on Form 4684, specifically line 15, you do not include that amount on line 6 with other casualty losses. Instead, you list it separately down on line 7, labeled as other itemized deductions.
Okay, so disaster losses get special treatment on line 7. What else goes on line 7? Other itemized deductions. And you mentioned something very specific for students from India.
Line 7 is kind of a catch-all for less common itemized deductions allowed to non-residents. But yes, there's a very unique rule here for certain individuals from India. If you are a student or business apprentice from India who qualifies for the benefits under Article 21.2 of the U.S.-India Income Tax Treaty, and you choose to take the standard deduction instead of itemizing, and you also have a net qualified disaster loss from Form 4684, line 15.
So that's a lot of conditions.
It is. But if you meet all of them, you can actually increase your standard deduction amount by the amount of that net qualified disaster loss. You report this specific disaster loss amount on the dotted lines next to line 7 of Schedule A, even though you're taking the standard deduction overall. It's a very niche rule, but a great example of how treaty benefits can interact with standard tax rules in unexpected ways.
Wow, that's deep in the weeds, but potentially very valuable for that specific group. Okay, let's move from deductions to credits. Schedule 3. Credits are generally better than deductions, right? Because they reduce your tax dollar for dollar.
Exactly. Credits directly cut your tax liability, whereas deductions only reduce the amount of income subject to tax.
What non-refundable credits are available on Form 1040-NR? These can reduce your tax to 0, but you don't get any excess back as a refund.
Several important ones. The foreign tax credit, using Form 1116, is crucial if you have foreign source income that's also being taxed by the U.S. as part of your ECI to avoid double taxation. The general business credit, Form 3800 and related forms, might apply if you have business activities generating specific credits.
What about those green energy credits?
Yes, the clean vehicle credits are available, both the credit for new clean vehicles and the credit for previously owned clean vehicles, claimed using Form 8936. The rules have been changing, so check the latest Form 8936 instructions, but they are potentially available to 1040 NR filers who purchase qualifying vehicles for use in the U.S.
Any others?
The Retirement Savings Contributions Credit, also known as the Saver's Credit, Form 8880, can be claimed by eligible lower to moderate income taxpayers contributing to retirement plans. But you have to follow the 1040 NR filing status rules when figuring eligibility.
What common non-refundable credits are not available for 1040 NR filers? Things like education credits.
Right. The education credits, like the American Opportunity Tax Credit and the Lifetime Learning Credit, Form 8863, are generally not available to those filing Form 1040 NR. Also, the credit for the elderly or disabled Schedule R is typically not available.
Okay. Now, for refundable credits, these are the best kind because even if you owe zero tax, you can get the credit amount back as a refund. What's available here?
One is the Net Premium Tax Credit, Form 8962, related to health insurance purchased through the marketplace. However, as we discussed with the self-employed health insurance deduction, eligibility for this is very limited for most 1040 NR filers, generally restricted to U.S. nationals or residents of Canada, Mexico, South Korea, or certain Indian students' apprentices.
Any others?
There's a credit for repayment of amounts included in income in earlier years if you had to pay back income previously taxed. Section 1341 credit. But the big one that causes confusion is the child tax credit, additional child tax credit.
Right, we mentioned this earlier. Extremely limited for 1040 NR.
Very. It's only available in full if you are a U.S. national or a resident of Canada or Mexico with a qualifying child who has an SSN. Residents of South Korea may claim it under certain treaty conditions, and certain Indian students' apprentices might qualify for a limited version. For almost everyone else filing 1040 NR, even if they have qualifying children living with them in the U.S., these credits cannot be claimed. This is a major difference from resident taxpayers.
A really important point to understand. And one more huge refundable credit that's not available.
The Earned Income Credit, or EE. This credit, which provides significant support to low to moderate income working individuals and families in the U.S., is explicitly not available to anyone filing Form 1040 NR, period.
Okay, so the takeaway on adjustments and credits. Review them carefully, understand the ECI connection for many adjustments, be aware of the very specific and often strict limitations for non-residents, especially on dependent credits and EIC, but definitely claim what you are entitled to, like treaty benefits, foreign tax credits, or maybe those clean vehicle credits.
Precisely. Know the rules, know the limits. Yeah. Now, briefly, let's touch on other taxes, Schedule 2, and payments, lines 2134.
Schedule 2, this is where extra taxes get added on top of your regular income tax.
Yes. Things like the Alternative Minimum Tax, AMT, though less common now, could potentially apply. Additional taxes on early withdrawals from IRAs or other retirement plans if exceptions don't apply. Household employment taxes if you employed a nanny or housekeeper, Schedule H. It's important to note that the net investment income tax, NIIT, that extra 3.8% tax on investment income, generally only applies to non-resident aliens if they are dual status taxpayers, and then only to the income earned during the resident period if their income exceeds the thresholds.
Okay. And payments, that's where you get credit for taxes already paid.
Exactly.
Right.
This is where you report federal income tax withheld from your paychecks, Form W-2, or withheld by payers on other income, like Form 1042-S for payments to foreign persons, or Form 880-5A288 TAC related to partnerships or real estate sales. It also includes any estimated tax payments you made throughout the year using Form 1040-ES-NR.
And you mentioned earlier a heads up about refunds involving some of those forms.
Yes, it bears repeating. If your refund claim involves taxes withheld and reported on Form 1042-S, Form 8805, or Form 8288-A, the IRS specifically warns that processing these refunds can take up to 6 months. It doesn't necessarily mean there's a problem, just that verifying these withholding amounts takes extra time. So, patience is needed.
Good to manage expectations there. Okay, so after all the income adjustments, deductions, credits, other taxes, and payments are tallied, you arrive at the bottom line, either a refund or an amount you owe. How do you figure the tax itself?
You'll use the official IRS tax table or tax computation worksheet found in the Form 1040 NR instructions. Based on your taxable income, AGI minus standard or itemized deductions, and your filing status, usually single or married filing separately, you find your tax liability.
And if you're due a refund.
The IRS strongly recommends using direct deposit. It's the fastest and safest way to get your money. You provide your U.S. bank account routing and account numbers on the form, and the refund goes straight into your account. Much better than waiting for a paper check in the mail, especially internationally.
Definitely safer. And if you owe money, what are the ways to pay?
You've got lots of options. You can pay electronically through IRS Direct Pay from a bank account, or use a debit card, credit card, or digital wallet, though third-party fees usually apply for card payments. You can pay by phone through the IRS To Go mobile app, or by check or money order mailed with Form 1040V payment voucher. Make sure checks are drawn on a U.S. financial institution. You can even pay with cash at certain participating retail partners or do a same-day wire transfer from your bank.
And what if you didn't pay enough tax throughout the year via withholding or estimated payments?
You might owe an estimated tax penalty. The IRS wants you to pay taxes as you earn income. If you owe more than a certain amount when you file and didn't meet certain exceptions, like paying enough based on last year's tax or having enough withheld, you might have to calculate and pay this penalty, typically using Form 2210F, underpayment of estimated tax by farmers and fishermen, or the penalty calculation in the 1040NR instructions.
Okay, last step. Signing and assembling the return. What's key here?
You must sign and date your return. An unsigned return isn't considered filed. If you use a paid tax preparer, they also must sign the return and provide their Preparer Tax Identification Number, PTIN. But remember, even if someone else prepares it, you are ultimately responsible for the accuracy of everything on that return.
Good reminder. And how do you put it all together if you're mailing it? Is there a specific order?
Yes, there's an assembly order. Attach copies of forms showing federal income tax withholding, like Forms W-2, W-2G, 1099-R, to the front of Form 1040NR in the designated spot. Also attach Forms 1042S, SSA 1042S, RRB 1042S, Form 2439, and Form 8288A to the front. If you have corrected W-2s, attach both originals and corrected versions.
Okay. Withholding forms on the front. What about other schedules or forms?
Any other schedules and forms like Schedule A, Schedule NEC, Schedule OI, Form 8840, Form 8833, etc., are attached behind Form 1040NR, usually in the order of their sequence number or attachment sequence number if provided. Form 8805, related to partnership withholding, specifically goes on the back.
And if you're mailing a payment?
Do not staple or attach your check or money order to the return itself. Just enclose it loosely in the envelope along with Form 1040V if you're using that voucher.
Okay, that covers the form itself in detail. But navigating the form is only part of the battle. There are a lot of resources out there to help taxpayers write, especially when dealing with something potentially unfamiliar like the 1040NR.
Absolutely. The IRS actually offers quite a bit of support, and much of it is free. It's worth knowing about these. First off, let's talk about filing itself. Electronic filing, or e-file, is really the way to go now.
E-file. We hear about it all the time. What are the real advantages for someone filing Form 1040NR? Why bother if you're used to paper?
Oh, the benefits are pretty compelling. Security is a big one. E-file uses the latest encryption, much safer than mailing sensitive info. Accuracy is another. The software catches common errors, which means fewer mistakes and faster processing by the IRS.
Faster processing is good. What else?
You get confirmation almost immediately that the IRS received and accepted your return, which gives you peace of mind. You can often file early but schedule your payment closer to the deadline if you owe. It's greener, less paper. And the big one for many, you generally get your refund much faster, especially if you combine e-file with direct deposit. The IRS says 8 out of 10 people get refunds faster this way.
Faster refunds are always popular.
And honestly, most professional tax preparers are actually required to e-file returns now. It's really become the standard.
Okay, so e-file is generally better, but what if you're stuck? You've read the instructions, maybe tried the software, but you still need help understanding something or resolving a problem with the IRS. What free resources are out there?
The first place to know about, and it's a fantastic resource, is the Taxpayer Advocate Service, or TAS.
Taxpayer Advocate Service, what do they do?
TAS is an independent organization within the IRS. Their whole job is to help taxpayers solve problems they haven't been able to fix through normal IRS channels and to protect taxpayer rights. They're literally your advocate inside the system.
So, like, having someone on your side within the IRS, when should you contact them?
You should reach out to TAS if your tax problem is causing you significant financial difficulty, or if you've tried repeatedly to resolve an issue with the IRS directly and haven't gotten anywhere. Also, if you think an IRS system or procedure isn't working correctly and is causing problems.
Is it free?
Yes, the service is completely free. If you qualify, you'll be assigned one specific advocate who will work with you personally to try and resolve your issue. You can find them online at taxpayeradvocate.irs.gov or call them toll-free at 877-777-4778.
That sounds incredibly valuable. Are there other clinics or services, maybe outside the IRS, that offer help?
Yes, there are low-income taxpayer clinics, or LITCs. These are independent from the IRS and TAS, often run by law schools or nonprofits. They represent individuals whose income is below a certain level and who need help with tax disputes like audits, appeals, or collection issues.
What they charge?
They offer services for free or for a small fee. And importantly, they often provide information and assistance in multiple languages. You can find a map of LITCs across the country at taxpayeradvocate.irs.gov LITC map.
Good option for those who qualify. What if you just want to give feedback to the IRS, like suggest improvements?
That's what the Taxpayer Advocacy Panel, or TCAP, is for. It's a group of citizen volunteers who listen to taxpayer concerns, identify broader issues, and then make recommendations directly to the IRS leadership on how to improve services and processes. You can share your suggestions through their website, improveirs.org.
Okay, and then there's the main IRS website itself, irs.gov. It's huge. What are some key tools or sections that are specifically helpful for navigating taxes?
irs.gov is really the central hub. For filing, depending on your income and complexity, you might qualify for IRS Free File, which lets you use brand name software or fillable forms to prepare and e-file your federal return for free. There's also IRS Direct File in some states for simpler returns.
What about getting help preparing the return, not just filing software?
There are two main volunteer programs. VITA, Volunteer Income Tax Assistance, offers free tax help primarily to low to moderate income folks, people with disabilities, and limited English speakers. TCE, Tax Counseling for the Elderly, focuses on taxpayers who are 60 or older, often specializing in pension and retirement issues.
Yeah.
You can find VITC sites near you through irs.gov. And for military members and veterans, there's MilTax, a free service offered through Military OneSource.
Lots of free help options. What about planning tools, like figuring out withholding?
Yes, the tax withholding estimator tool on irs.gov is excellent. You plug in your expected income, deductions, credits, and it helps you figure out if you need to adjust your Form W-4 with your employer to avoid owing a lot or getting a massive refund. There's also a sales tax deduction calculator if you're itemizing and want to deduct state sales tax instead of income tax.
And forms and publications?
You can download virtually any current or prior year form or publication directly from irs.gov forms. Super convenient.
Can you check your own account information online?
Yes, individuals can create an online account at irs.gov account. It's secure, and you can see things like your balance owed, payment history, access tax records like transcripts, view certain IRS notices, and even approve or reject authorization requests from tax professionals.
That sounds useful. And language support.
irs.gov has information available in multiple languages at irs.gov language. And if you call the IRS, they offer free over-the-phone interpreter OPI services in hundreds of languages.
It really sounds like they're trying to make information accessible. You mentioned the Taxpayer Bill of Rights earlier. Why is knowing those rights important?
It's fundamental. Every taxpayer has 10 basic rights when dealing with the IRS. Knowing them empowers you. They include things like the right to be informed, the right to quality service, the right to pay no more than the correct amount of tax, the right to challenge the IRS's position and be heard, the right to appeal an IRS decision in an independent forum.
The right to finality.
Right. The right to privacy, the right to confidentiality, the right to retain representation, and the right to a fair and just tax system. Understanding these helps you know what to expect and what you're entitled to in any interaction with the IRS.
And one last thing on resources. Protecting yourself from identity theft, that seems like a constant worry.
It is. The IRS offers the Identity Protection PPIN, or IPPIN program. It's a voluntary program where the IRS assigns you a unique 6-digit PPI each year that you must use when you file your federal tax return. It helps prevent someone else from filing a fraudulent return using your Social Security number. You can learn more and request one, if eligible, at irs.gov/IPPIN. It's a good extra layer of security.
Definitely worth looking into. Okay, before we wrap this up, let's do a quick run-through of what's new specifically for the 2024 tax year, the return people will be filing in early 2025. Any major changes 1040-NR filers should be aware of?
Well, the basics first. For most people filing Form 1040-NR who are employees receiving wages subject to U.S. withholding, the due date for the 2024 return will be April 15, 2025.
Okay. Any changes to credits we discussed?
Yes, a couple of minor tweaks and one increase. The maximum amount for the refundable additional child tax credit increased slightly to $1,700 per qualifying child for those eligible, like residents of Canada, Mexico. Schedule 3, which lists credits, has revised line 13B for the Section 1341 credit for repayment of prior year income and added a new line 13 sec as a catch-all for other refundable payments.
What about taking money out of retirement plans? Any new exceptions to that 10% penalty for early distributions?
Yes, starting in 2024, there are a couple of new exceptions. You might avoid the 10% penalty for distributions used for certain emergency personal expenses, up to $1,000 per year, and also for certain distributions made to victims of domestic abuse, up to the lesser of $10,000 or 50% of the account balance. These provide some relief in very difficult situations.
That's good to know. And the clean vehicle credits. You said those rules keep changing.
They do. The main credit for new vehicles was officially renamed the Clean Vehicle Credit. There were some adjustments to the maximum credit amount and the requirements for vehicles to qualify, particularly around battery component sourcing. It's still claimed on Form 8936. The credit for previously owned clean vehicles is also still available. Definitely need to check the latest Form 8936 instructions for the specifics when filing.
Right, always check the latest instructions. And that self-employed health insurance deduction.
The main change we noted was the form. If you qualify for the deduction but can't use the standard worksheet, you now use Form 7206 to calculate it. Rather than relying on Publication 535, just direct you to a dedicated form.
And that qualified charitable distribution one-time election from an IRA? Did the amount change for 2024?
Yes, it got a boost. For 2024, that maximum amount you can elect to distribute tax-free from an IRA to charity via split interest trust increased from $50,000 to $53,000. A nice little inflation adjustment there for philanthropic planning.
$53,000 now. Okay, wow. So, quite a few updates, but the core principles seem consistent. Let's try to boil this whole deep dive down. What are the absolute key takeaways for someone facing Form 1040 NR?
Number one, without a doubt, get your residency status right. Non-resident, resident, dual status, everything flows from that determination. Use the substantial presence test, understand the exceptions, know about the closer connection claim and Form 8840, and the election to be treated as a resident if married. That's job one.
Okay, residency first. What's number two?
Number two is mastering that fundamental divide between effectively connected income, ECI, and U.S. income not effectively connected, NECI. Knowing which determines your tax rate, graduated versus flat 30%, and critically, whether you can take deductions against that income. Getting this wrong costs money.
ECI versus NECI. Got it. And number three?
Number three is to be proactive and thorough in exploring all the potential ways to reduce your tax. Dive into those adjustments to income that apply to ECI. Carefully review the itemized deductions on Schedule A, 1040NR, especially the rules for state local taxes and gifts to U.S. charities, remember the documentation, and hunt down every credit you're eligible for. Foreign tax credit, treaty benefits, huge, maybe those clean vehicle credits. But also be brutally honest about the credits you cannot claim as a non-resident, like EIC and generally the child credits.
So it's about knowing what doors are open to you and which ones are closed.
Exactly. The Form 1040NR can look intimidating, absolutely. But hopefully listeners see now that it's manageable. It's a process you don't have to face completely unprepared. With the right information, knowing the rules, understanding the key distinctions, and being aware of where to find help like TS or the IRS website, you could approach this not just as a chore, but as a way to ensure you pay exactly what you legally owe and not a penny more.
It makes you wonder, what other seemingly tiny details buried in tax forms or instructions might actually unlock unexpected savings or benefits? The deeper you're willing to dig into the official guidance, the more potential advantages you might find.
And that's our deep dive for today. We really hope this has helped demystify Form 1040NR and giving you a clearer path forward for tackling your U.S. tax obligations.